Anytime anybody talks about Airbnb markets, we always talk about the best markets or what market is up and coming. But what about the markets that are actually terrible to enter into? Don't worry, I'm going to save you all of the headache, and we're going to talk about the worst Airbnb markets to look into for 2026 and beyond. Let's get into it. Running short-term rentals is constant work. Guest in, guest out, and you're still expected to be your own bookkeeper? I had multiple listings going and no real way to manage the money that was coming in. Between flipping beds and trying to match receipts from a payment a month ago, I couldn't even know if I was making real money. That's when I found BaseLane. It's the official banking platform of BiggerPockets, and it handles all of the tracking and reporting I used to do manually. Now I can see real-time financial reports for each listing and know if there's a problem that's arising. For example, last month I had a 300% spike in my electric at one of my properties, and I realized that I needed to do something. I quickly set up a smart thermostat inside of it, and my electricity bill was cut almost in half. Thanks to things like BaseLane, I avoided losing my profits and actually getting them back in my pocket. Start protecting your profits today by signing up at baselane.com/BP, and you'll get your $100 bonus right when you sign up. Hey everyone, welcome back to another episode of BiggerStays. My name is Garrett Brown. I'm the resident BiggerPockets short-term rental expert and a short-term rental Airbnb investor myself for over 5 years in Houston, Texas, and a few different markets around Texas. Now, while I don't personally invest in tons of markets all the way around because I believe in the economy of scales when I'm building a business like this, I also deep dive in data every single day about what short-term rental markets actually are performing and which ones are more of a headache to ever even think about getting started in. I'm going to walk you through real data, regulation red flags, and case studies so that way you steer clear of any mistakes when looking at your next market. Before we dive in, if you like this type of content, please let us know in the comments, hit the like button, and subscribe so that we know this is the type of content you want to have coming from us. That way we can build up all the short-term rental investors out there to the best of our abilities and the best of your abilities. Let's make your short-term rental a long-term success and get into some of the worst markets out there today. So before we start naming specific markets, we need to define what makes a bad market. There are 6 things I look at when I'm looking at a market that might not be one you should invest in. First is the tourism. Do they have weak demand? Second, the amount of supply in the area. Is this area oversupplied with the amount of demand that comes? Third, the high entry cost to get into certain markets with a low yield. Think of really high insurance rates, really high property taxes, really high mortgage rates, anything like that, it's going to be a no-go. Fourth is the regulatory risk. Do these areas actually want short-term rentals in that city? 5 is the unpredictable rules or political risk. Some areas just don't make sense, and this kind of ties into the regulation side, depending on what the landlord-tenant laws and a few other things that actually happen there. And then the last thing is the high fees or taxes or the licensing burden that comes with being a short-term rental host. Some areas charge a couple $100 to get a permit. Some places will make you sell your firstborn child to try and get a permit. It's all going to depend, and this is why we research it before we get into it. So what even made me write this article that I did for BiggerPockets, which I will link in the description below if you want to read all of the data I put into this blog article. But what sparked is there was a 2024 report from Clever Real Estate Investing, which picked out 10 different markets that they believe were the worst performing markets out there. Places like Birmingham, Alabama, San Antonio, Texas, even my beloved Houston, Texas, which I halfway agree with, Sacramento, San Francisco, and quite a few others. But their big one that was a complete no-no to them was San Jose, California. Their reason? Very high property prices, low proportion of suitable short-term rental listings, and a very strict regulation environment. Now, all of these markets could have a few unicorns or a few properties or very efficient property managers or co-hosts or investors that get a good deal, could still perform well in. But from an overall perspective, it is going to be much harder, in their opinion. I don't agree with every single market on this list, but I always want to put the caveat out there that every market could have a few properties that could still perform, especially if you get outside of the city a little bit and outside of the regulation that really control the tighter urban style cities. But most data is pointing that these are not the best markets to jump into if you're truly trying to build a vacation rental business or short-term rental business, anything in that kind of bubble. So one of the biggest factors as we're talking about these markets that we're going to lay out shortly is really comes down to the regulations and the legal risk. People hear regulations and instantly get terrified when they hear it, but most of the time regulations can be a somewhat good thing for investors. you at least know that that city has sat down and thought about short-term rentals and how they're going to work with them or ban them or work within them, whatever they decided. The cities that really scare me as well are the ones that haven't even had any regulations, because at any point they could become like one of the cities on my list where making a profitable short-term rental becomes so hard just because that city really doesn't want short-term rentals there, whether it's hotel lobbying, neighborhood complaints, all of these things. I personally have never been a big fan of buying a short-term rental in a residential neighborhood that no other short-term rentals actually exist in, because that's just not what a true vacation rental I think is. Now, there's also business short-term rentals and all these different, niches within it. But if you are the only short-term rental in an HOA neighborhood, you are barking up the wrong tree, I promise. And especially if there's not a demand for tourism or that city doesn't really rely on short-term rentals, you're going to run into problems most likely. And one bad guess is going to ruin it all for you. So most of the regulation pitfalls come when cities ban whole home short-term rentals or non-owner occupied short-term rentals, which a lot of these cities on the list have regulations within it, especially within city limits. All of these cities, you could go outside some and find something that doesn't fall in these regulations, but the further you get out the city, the less likely people will book unless you have a really unique stay. But that's not what this video is about. So I'll give you an example for one of the markets that we will be going into shortly is New Orleans. Airbnb and New Orleans are in a massive fight especially after the Super Bowl. New Orleans now has restricted whole home rentals outside of certain zones, which is very, very small zones, and most of them are probably not even properties that are going to be short-term rentals, maybe depending on the owner. Another big rule that will drastically stop your short-term rental momentum is limiting your short-term rental only to people's primary residence, where what kind of Airbnb was built out where somebody hosts in the guest house. This is kind of the instance in Los Angeles. This only allows for most areas for the STR owners to rent out their house if they actually live in it. Whole home rentals are heavily restricted in Los Angeles, just like New Orleans. There also may be a cap on the number of nights or permits that you can have. San Diego, which is another city I personally would not invest in, even though I do know some successful investors out there. So if you're watching, you're doing great. It's not for me. But San Diego, for example, limits the wholesale licensing and restricts the whole home licenses to just about 1% of the actual housing stock. Now, one of the biggest poster childs for a city not to currently invest in for short-term rentals is New York City. Most places have a cap on how many nights you can actually rent, and if you can even rent out a place that is non-owner occupied. And New York City and Airbnb are in a massive fight themselves between legal battles of this, and if it's actually helping the housing supply in New York City. Airbnb says no. New York City still thinks so, even though the data probably proves Airbnb is correct in this one. Denver is another city that is very, very hard to invest in for short-term rentals. A lot of areas in Colorado make for good short-term rentals, but the city of Denver requires your short-term rental to be your primary residence, and you have to pay a pretty hefty lodger's tax. I think it's about 11% on top of other taxes and fees they will add on. Honolulu, Hawaii is obviously one of those beautiful places around, but another very strict short-term rental regulation area. You really only can have these unhosted vacation rentals into the resort areas where you're competing with hotels and other things like that. It's doable, but regulations are very, very tight out here as well. Nashville, Tennessee is another one that I know a lot of successful investors in, but they make it a lot more difficult for non-owner occupied places to make sure they fall within the actual zones they need to be in. And they also restrict how close a lot of short-term rentals can be to each other. It's just another area that if you're not occupying the home, it's a little tougher to find a deal because of all the hoops and red tape you're going to have to jump through. Now, Atlanta, Georgia is another one that is very tight on the amount of units you can have. You can rent out your primary residence, and I believe you can have one other unit on top of that you rent out as well. So you can have one investment unit and your primary residence, which you host, and however you do that, Atlanta, Georgia is definitely one that's still cracking down on it. And even suburbs outside of these major cities are starting to really crack down on it as well. If you take Brookhaven, Georgia, which is slightly outside of Atlanta, they restrict short-term rentals to only owner-occupied homes, and the host must show proof of their homestead exemption and pay the local taxes with it. So most of these cities have in common that the more urban the city and metro, they probably are less likely to be happy that short-term rentals are coming to them. So you don't want to battle the city and an HOA. Here's just a quick checklist of what you can run down as you look down my 6 things to decide if this is a bad Airbnb market or not. Is on the tourism side, look into the monthly and seasonal visitors that come. You can Google this information, ChatGPT, see what their visitor numbers are, convention traffic, nearby attractions, and what the natural attraction is for people to actually come there. The second part is look at the supply, the number of active short-term rental listings, new developments or condo projects that might be coming along, and what are the occupancy rates in these areas. The third is do a yield and pricing analysis. Look at your all-in cost on top of just the purchase cost, taxes, insurance. All these things really will matter. What is your expected average daily rate? And how many people are actually going to rent it off the occupancy that we talked about? Once you start to really get your numbers and dive in, what is your net cash flow going to be? And what is the chance of appreciation in this area going forward? We've talked about regulatory risk. It's huge. Always avoid HOAs, in my opinion, unless you are one of many short-term rentals in it, because at any point they could snap their fingers and really cause you a lot of problems. But one of the main best things, especially if you're looking at some of these metro urban markets, is to know what your exit options are. Price it out as a monthly rental. Price it out as a long-term rental. Price it out if you sold it in a couple years. So figure out what are your exit strategies to get out of there as a real estate investor and not only rely as a short-term rental. Because if your short-term rental gets shut down and it doesn't make a good monthly rental or a good long-term rental, you're probably going to have to sell it or do something else very quick and realize that you should have planned a little bit better ahead. Now, I don't want to scare you with all this because there are a ton of really good vacation rental markets. One of my best pieces of advice is just find areas that truly have already set out some regulations and really crave for tourism to come there, that they thrive on it. These kind of cities will just never have the ability to shut down short-term rentals, because these cabin rentals and lake rentals and mountain rentals, beach rentals, they've been happening way before Airbnb ever existed, and they're going to be happening for years to come because these cities thrive on it. So if you made it this far to the end of the video, I really appreciate you watching. Let me know in the comments if any of these cities you invest in and how it's going for you. I'd love to hear how it has played out for you as things have developed in each of these cities. I did put the full blog article in the description as well. If you made it this far, please hit subscribe. I'll see y'all in the next one.